Hey, investors, and welcome to the first episode of the New to Investing Show, a show that aims to teach the fundamentals of money management and investing. My name is Jason, and in today's episode, we'll be covering checking accounts. For our first topic, we'll be covering the common benefits of having a checking account, like an access to a debit card, checks, ATMs, and other perks that come with opening a checking account. In our second topic, we'll be discussing some of the downsides associated with checking accounts. We'll review the various fees that can exist on them, the common practice of accounts not having interest on them, and the overall lack of security around the accounts. And in the final topic, we'll be comparing different types of checking accounts and discussing some of the key features that they offer. Let's go ahead and start things off by quickly highlighting the definition of a checking account. A checking account is a deposit account held at a bank or other financial institution that allows money withdrawals and deposits. Checking accounts are very liquid and can be accessed using debit cards, checks, ATMs, among other methods. A checking account differs from other bank accounts in that it often allows for numerous withdrawals and unlimited deposits, where a savings account sometimes limit both. With that being said, you may be wondering what are some of the key benefits of opening an account like this. First off, you'll gain access and be able to start using a debit card, which will allow you to start making purchases and or withdraw funds from your bank or an ATM. Another benefit of having a checking account is you'll have the ability to allow your employer to directly deposit your paycheck into your checking account for a safe and quick way to access your money. This is what's known as direct deposit. You'll also have access to online banking. You'll have the ability to pay your bills right from your checking account without having to even write a check. And one of the last benefits of having a checking account is that most checking accounts in the US are insured by the Federal Deposit Insurance Corporation, or FDIC for short. They're usually insured up to $250,000. You'll need to verify the exact amount with your bank. This ensures that your money is safely stored in your account. So let's summarize some of the key benefits of having a checking account. Checking accounts are inexpensive, easy to use, and are a safe way to store your money with little risk involved. They also offer additional benefits, like the ability to use a debit card, write checks, and have access to ATMs. Now that we've discussed the benefits of using a checking account, let's take some time to highlight some of the downsides of having them. Some checking accounts have fees associated with them. For instance, an account could have a monthly or a maintenance fee, where the bank charges you a set amount of money every month. They also could impose a minimum balance fee, where if your account doesn't reach $3,000 consistently every month, you're charged a fee. You could be charged potential overdraft fees, to where if you have $1,000 in your account, but you spend $1,100, you'll be charged a fee on that. And then, of course, potentially buying and using a debit card could have fees associated with it. Not to mention some additional bank transaction fees. It's important to note that not all checking accounts have these fees associated with them. These are just some of the fees that you could see within a checking account, and it's up to you to do your research to find out which fees there are. Now, when you're doing your research on different checking accounts, keep in mind of bank security. It's worth noting that another downside to using a checking account is the general lack of security that some banks offer on their accounts. It's also worth mentioning that the inherent nature of the direct access to your money that checking accounts offer. This direct access concern is present in many forms of saving and investing accounts, but at least it's worth calling it out so you know what to look for when searching for a checking account that's right for you. Lastly, the majority of checking accounts lack the ability to earn interest. This is one of the main reasons why checking accounts are not the best type of accounts to store all of your money in. We'll be covering interest in a future episode and take a deeper dive into it to help build a better understanding of it all. So to summarize, be aware of the checking account fees that exist on your accounts that you're looking at. Check to see if the checking account is offering any type of ability to earn interest on your money while it's being stored in the account. And lastly, check the different security options that your bank may offer on the account. Now I want to pause for a second to call attention to the next slide. This next slide is for informational purposes only, and the New to Investing show encourages for every investor to perform their own research and make their own decisions when it comes to selecting a checking account. The banks and the accounts I discuss next are to demonstrate some key factors to be aware of when looking for a checking account. For the last topic on checking accounts, we're going to spend some time discussing and comparing some major banks and the types of checking accounts that they offer. Some of the key factors that we're looking for are checking accounts that offer no account fees, no account minimums, and if they offer interest on the account itself. Some perks that we can also look for are sign-up rewards and the overall bank's reputation and accessibility in the real world, such as ATMs. Our first account is from Chase Bank. The checking account's name is Chase Total Checking. You can expect account fees of $12 a month unless you maintain a certain account balance throughout the month. They currently offer no interest on their account. You can expect a sign-up bonus of $355, and their overall accessibility for their bank is relatively high. The next account comes from Discover Bank. It's called the Discover Checking Account. This account has no account fees, has 0 account minimums, offers no interest rate, but one perk of owning this debit card is that the Discover Checking Account debit card offers 1% cash back on all purchases. The next and final account that we'll review for today comes from Capital One Bank. Their checking account is called Capital One Money. This account has no account fees, no account minimums, and they even offer 0.25% interest on your account. So if you're watching this video on YouTube, you can tell that there are 3 banks left: USAA, Wells Fargo, and Bank of America. I left these 3 banks on here for the viewers and the listeners to do their own research to see what types of checking accounts these 3 banks offer. I wanted to highlight the wide variety of banks that are out there and the different types of checking accounts that you can choose from. So in summary, every person is in a different financial situation and ultimately has different financial wants and needs. It's important to evaluate what type of features you would like to have in a checking account. Find out what those features are and then start comparing accounts while being aware of the factors that we've discussed today. Let's now take some time to recap the 3 different topics we learned today. The first topic was the benefits of using a checking account. Checking accounts are very liquid and can be accessed using debit cards, checks, ATMs, and among many other methods. They also allow for numerous withdrawals and unlimited deposits. The second topic were the downsides of checking accounts. Checking accounts often require a minimum balance, have certain fees associated with the account, and usually don't offer any interest to increase the value of the money in your account. And the last topic, we spent some time comparing different checking account choices. Determine your main usage for having a checking account, and then use that to compare the countless of different options out there. Research the different benefits each financial institution offers. And now for this episode's market news. In today's news, we have Nike stops selling on Amazon, Starbucks opens largest store, and Google buys Fitbit. For our first news item, we have an article here from Daniel Klein titled, Nike stops selling on Amazon, why that's good for investors. He says, Nike has made a decision that every manufacturer faces. It has decided to remove its products from Amazon to focus on building out its own distribution channels. This ends a pilot program that began in 2017, by which the sneaker company let the online giant sell some of its clothing and shoe lineup. In exchange for access to that limited assortment of products, Amazon promised to do a better job policing the sale of counterfeit Nike items. Now, the deal has ended right after the sneaker and athletic apparel company named former eBay CEO John Donahoe as its next CEO. His experience in selling straight to consumers may have influenced this decision. I think the former eBay CEO, John Donahoe, realized the importance of controlling your brand image. When you're starting to sell your own items on Amazon, you lose that kind of close touch with your product. Your product's going into the hands of Amazon's website, and at that point, sort of out of control. It's sort of out of your hands in a sense. Being able to sell on Amazon I mean, it is super fortunate, and it does kind of expose you to a wider audience. But you unfortunately lose out on a lot of insight into the sales information and on the type of target audience and the type of customer profiles that are building on your products when they're being sold on a different website. Another potential issue to keep in mind are the amount of counterfeit items and the counterfeit issues on Amazon. Nike doesn't want to put its products next to other counterfeit items. It could send a bad message. It could send a false kind of idea or a false representation of their product to its end consumers. If they end up purchasing these false counterfeit shoes, they're going to think they're true Nike products when in reality they're not. And last but not least, the article touched on it. By removing themselves from Amazon, they sort of maintain that control over their distribution channels. They're not so reliant on Amazon, and they're not dropping off that product at an Amazon warehouse and then leaving it up to their distribution channels to deliver that end product to the consumer. There's another article on CNBC News titled Nike, just the tip of the iceberg of companies ditching Amazon and selling directly to consumers. In this interaction, we have the ex-CEO of AOL, Tim Armstrong, give a great quote and explanation of where I think the industry is heading. Let's go ahead and play it.
Do you expect companies to move off of the Amazons of the world long term?
I think if they have the option to go direct, they're going to go direct. Again, look at what Disney's done with Disney Plus. Look at what Nike's done this week.
Right.
The direct-to-consumer movement will be the replacement for the retail issues and commerce issues that are going on because of the platforms. And again, I think it's a mega trend right now. I'm in it every day, and I see it. And I was at the beginning of the internet. I think this is another mega trend that's starting. And I think the Nike announcement is just the tip of the iceberg that's going to happen for direct-to-consumer.
Okay.
There's one thing I wanted to highlight that Tim just mentioned. He's saying that if the companies have the option to go direct, then they're going to go direct to consumers. I personally think this means that companies want to maintain that control of the customer experience through the entire kind of purchase life cycle of a product. So all the way from when the product is being made to when the product is being shipped and to when it even arrives on the customer's doorstep, the company maintains control of that entire experience. Not only is that super beneficial to building your brand and your image and creating the best user experience possible, it's also going to limit the amount of revenue sharing across your entire company. Since Nike's pulling its products off of Amazon's websites for the most part, they don't have to split the revenue costs with Amazon for each product that they sell on their site. They're now selling their shoes on their own websites, which increases their own revenue sharing, but also increases web traffic and probably overall sales on their sites. All right, our next article in our market news is from Starbucks. Starbucks has recently just opened one of their biggest stores in the world in Chicago. That's over 5 stories tall. And like I said, it's their largest Starbucks that they've created to date. And I personally think they're opening this store not only in a strategic location, but for a couple different reasons besides that. I personally think this physical location, it used to be an old Bath & Body Works, allows them to create one of their newer stores, which is called the Starbucks Reserve Roastery. They usually offer high-end coffee. And to me, what this signals is that Starbucks kind of wants to start looking into the different target audiences, start appealing to a couple different consumers to not only test things out and test the waters, but also find a new product that's going to help them increase the revenues year over year. Again, this type of building isn't unique to Starbucks. There are multiple different unique Starbucks across the world. And for instance, in the Penn Station in New York, there's a Starbucks there that's pickup only. This is for those who are, need to get their coffee fast. They're on the go. They don't have time to step in. They don't enjoy the experience of walking into a crowded store. They just want to order their coffee on their mobile phone because they already have the app, and they just want to quickly walk up to the store, up to the window, grab their coffee, and get going. To me, it's a brilliant experience. It cuts down on cost and just gets the end product into the consumer's hands. Another huge thing about the Starbucks Reserve is that since it is 5 stories tall, they can fill all of that square footage with just additional new products. I mean, whether it's a coffee mug, a piece of glass, coffee grounds, They even have their liquor license. So on all the different floors and all the different bars, not only are you ordering a latte or an iced coffee, but you can maybe order a cocktail. I mean, a beer. This new restaurant is more than just a coffee store. It's an entire kind of relaxing experience. It seems like they're going to be offering books for sale on the side. You could even read there. I mean, they're going to have their standard tables that you can plug your computer in and sit there and relax. It's kind of a one-stop shop for all your coffee and relaxation needs, it sounds like. So, I mean, not only is this a great opportunity to help build the Starbucks brand and test out different waters for different products and sort of attract different users or find out what their niche is or what their target audience is. Just an overall great way to get their name out there, try new products, and increase revenue. It's to me, I think it's brilliant. And we'll end this market news with a great quote that I had pulled from the article. It states, "Starbucks truly is attempting to offer something for every style and preference of customer, whether it's someone in a hurry or a person who'd rather sip and linger." To me, that quote is exactly what this building is, and I couldn't love it more. All right, in time for your last market news item of the day, we have Google buying Fitbit. After reviewing the Verge articles, Yahoo Finance articles, and Google's blog itself, it's obvious that Google has purchased Fitbit for $2.1 billion. By no means is this a small amount of money for Google. I know it's a very large company, close to $1 trillion, but $2.1 billion is a decent chunk of change. Google has obviously been thinking about this for a while. It's a very strategical purchase, and I wanted to spend some time to kind of nail down what I exactly think it is. First, I think they made this purchase to kind of better expose themselves to the health and wellness area, specifically wearables. So right now everyone knows what an Apple Watch is. Apple Watches dominate the wearable markets, if you could say. Google has their kind of Android watches, but Fitbit already has a large grasp on a large market share. Google wanted a way to kind of get into that space, and so purchasing Fitbit, especially when they had told the world that they were ready for sale, that was a no-brainer for them. So to me, this is obviously Google's answer to Apple's marketplace dominance. I mean, they've been making other purchases in the market that are not as highly publicized. There was an unknown smartwatch tech from Fossil that they had purchased previously in the year. They're going to be using these purchases to help create a better smartwatch experience and product for its consumers. On top of breaking into the market, the obvious other kind of gold rush that we have in today's world is user data. The more wearables that they can get on end users and their customers, the better. I mean, they're going to be building these user profiles of their health data and be able to do something with it in the near future that I think is going to create additional revenue streams for them. Now, obviously, that debate is up on the ethics of it all, but the fact that they have the data on hand gives them the ability to create a new product, to create new revenue streams in the future. I think it'll be interesting to see where it goes. I wanted to end this market news segment of Google buying Fitbit with a quote. This one comes from Mike Carpenter, who's a Fitbit user. He's concerned what Google will do with all of the data it collects, and he says that once their AI advances in 10 or 20 years, Google will have a trove of data that health insurance companies would love to get their hands on. Obviously, I've touched on this just a second ago, but I couldn't agree with Mike more. Not only is this a great way to break into the wearables market, I also think Google is setting themselves up for future revenue streams when they have all of that data of user health. It's going to be really interesting to see where it goes. Now that we've addressed our 3 market news items for this episode, I want to spend some time to address viewer questions. Our first viewer question is, how often are episodes released? And to answer that is, we plan on releasing a video and a podcast on a weekly basis. The exact day is still to be determined. Our next viewer question states, what's the type of content that will be covered? And to easily put it, the theme of this channel is to address the basics of investing and money management, so expect the beginner level of material on these topics for now. And our last question asks, where is information coming from? I obviously take the time to build these episodes. I reference multiple investing websites, videos, books, and published articles that I find. I find topics that are kind of near and dear to my heart, or topics that I think are important for new investors and for those who are trying to get their money management skills on track. And obviously, I'll always try to provide credit and links to my resources when available. So just the wide variety of different sources, and I'll always try to link it. Great questions. Thanks. And now it's time for the term of the episode. Today's term of the episode is liquid/liquidity. A liquid asset is an asset that can easily be converted into cash within a short amount of time. Cash is considered the most liquid asset. And for liquidity, it's the degree to which an asset or security can be quickly bought or sold in the marketplace at a price reflecting its intrinsic value. All right, before the show comes to an end, before those credits roll, I wanted to spend some time reviewing our social media outlets. You can find us over at Twitter @InvestingShow. And then for Instagram, Facebook, and YouTube, and our variety of podcasts, you can find us @NewToInvestingShow. And then, of course, our website's under construction at the moment, but when it's live, you'll be able to go to www.newtoinvestingshow.com. And of course, if you've learned anything new in this video, then please feel free to leave a like, follow, subscription, or comment. It's greatly appreciated, and it really helps grow the show. Thanks. I also wanted to provide credit and a huge thanks to all those involved who helped make this episode possible, from the presentation template by SlidesGo, the icons by Flaticon, the infographics, images, symbols, all created by FreePic. Again, a huge shout out to Blackmagic Design for their DaVinci Resolve video editor. Couldn't do the show without it. And of course, Investopedia, Forbes, Zacks, and First Source for the episode's topic information. Couldn't have done without those resources there. And lastly, Motley Fool, CNBC, Forbes, The Verge, and Yahoo Finance for the episode's market news. Thanks. Before you go, I wanted to provide a quick disclaimer. The New to Investing show is for informational purposes only and is not intended to serve as a recommendation to buy or sell any security, and is not an offer or sale of a security. The New to Investing show is also not a research report and is not intended to serve as the basis of any investment decision. If the New to Investing show covers a service or security that one of the hosts uses or owns, we'll make sure to let you know. Hey investors, Jason here. I wanted to point out that in today's episode, I spent time talking about Apple, Bank of America, Nike, and Starbucks. I just wanted to let you know that I own shares in all of these companies. Well, that's going to do it for today's episode. I hope our new investors learned something new about checking accounts, and I hope you're able to take that knowledge and use it to grow into a successful investor. To continue learning about the basics of money management and investing, please feel free to subscribe to my channel and/or follow me on the various podcast platforms. Thanks, and catch you in the next episode.